Well, there's been a lot of talk lately about silver maybe getting ready for one of those moments where it stops looking tired, stops looking stuck, and then all of a sudden starts moving in a way that leaves a whole lot of people behind. So in this video, we're going to separate what matters from what only sounds dramatic, and you are going to walk away feeling a lot smarter and more prepared about silver, gold, and the economy sitting behind both of them. Today is Sunday, April 12th in New York. So drop a comment below and tell me what day and date you're watching from. And real quick, if you value the work I do, support the channel by subscribing and commenting John A.G. Best. That lets me know you want more of these breakdowns. Now, the reason this is getting so much attention is pretty straightforward. People are looking at silver and saying, hold on a second, haven't we seen this movie before? Big move up, nasty pullback, confidence gets shaken. Then after everybody decides the fun is over, silver turns around and runs harder than most people thought it could. That is the comparison getting tossed around right now. And I get why people are interested in it. Because when a chart starts reminding investors of one of the most violent silver moves in modern memory, it's naturally going to get attention. But here's the part that actually matters. A chart by itself doesn't carry the whole case. It can suggest a setup. It can tell you where traders might start leaning. But the bigger move, the one that matters, usually needs a macro story strong enough to feed it. And that macro story right now is not small. Based on the latest inflation release, consumer prices in the United States were up 3.3% from a year earlier in March, while energy posted a massive monthly jump and gasoline made one of its largest monthly leaps on record. The preferred inflation gauge also stayed warm, with the latest personal consumption expenditures price index still running in the upper 2% range. In other words, inflation did not vanish. It cooled from the worst levels, sure, but it did not disappear. And energy just reminded everybody how quickly that story can turn. That matters for silver and gold because inflation is not just about prices going up on paper. It's about purchasing power getting chipped away in real life. It's about what happens when the money in your pocket buys a little less, while the things you actually need keep demanding more. And once energy starts acting up, that pressure has a way of spreading. It doesn't stay politely in one corner. It leaks into shipping, into food, into services, into expectations, and eventually into behavior. That behavior shift is already visible if you know where to look. Take home improvement demand. From recent company commentary and filings, the message has not been that the consumer is fearless and charging into giant renovation dreams. The message has been more cautious than that. Home Depot said bigger discretionary projects remain under pressure, while categories like plumbing and electrical held up better. Reuters also reported that economic uncertainty, affordability strain, and a softer labor backdrop were making consumers more cautious about major renovations. And that distinction matters a lot more than people think. Because one of the first signs of a stressed consumer is not that spending disappears, it's that it changes shape. Instead of new kitchen fantasies, it's repairs. Instead of premium upgrades, it's maintenance. Instead of replacing something early, it's squeezing another year or two out of what you already have. That's how the mood shifts before the data catches up in a way everyone can see. You can also feel it in mass retail, although here I want to be fair and not turn every value purchase into proof of collapse. Walmart has done extremely well. And part of that success is precisely because its value pitch has attracted not just lower-income shoppers, but more affluent households too. Recent reporting and company commentary both show that shoppers across income brackets have been leaning into value and convenience. So no, a crowded value retailer does not automatically mean recession is around the corner. But it does tell you something important. It tells you the consumer is more price-aware than the happy headlines would suggest. It tells you that stretching money has become normal, not exceptional. Then you get to used cars. And this is another one of those areas where the market gives you useful clues if you stop looking for perfection and just listen carefully. CarMax, the largest used car retailer in the country, reported that retail used unit sales fell by about 8% in its latest quarter. Comparable store sales were down by around 9%, and total retail used vehicle revenue also slipped. Reuters described weaker demand and lower prices in the used car market, and also noted that the company's chief executive was stepping down after pressure for better performance. That doesn't mean the whole economy is imploding because a used car company hit a rough patch. But it absolutely tells you the consumer is not behaving like money is easy and confidence is overflowing. And if you're a silver investor, you should care about that. Not because a used sedan sets the silver price directly. Obviously not. You care because silver sits in this strange middle ground where it can trade like a monetary hedge and an industrial metal at the same time. That means when the economy gets shaky, silver can get pulled in two directions. The fear side can help it. The growth side can weigh on it. That's why silver is so exciting when it gets moving and so frustrating before it does. This is the part stackers need to hear clearly. A weakening economy does not guarantee silver immediately goes vertical. Sometimes the exact opposite happens first. If liquidity tightens, if traders need cash, if funds get forced to sell what they can rather than what they want, silver can absolutely get hit in the short term. We've seen that before. So when I say silver may be building toward a serious move, I am not promising you a smooth ride. I'm warning you that the path could be ugly before it gets glorious. That strengthens the case for being prepared. Because if silver does what it often does in high-stress periods, it will try to shake out the late buyers, the weak hands, and the people who thought conviction meant never having to sit through volatility. Conviction without preparation is just emotion wearing a nicer suit. According to the latest employment report, payroll growth in March was positive, but the broader labor backdrop still looked like an economy that had changed little on net over the prior year. That is not a booming labor market. It's not a collapse either. It's something more uncomfortable than that. It's a labor market that still has pockets of strength, but not much room for error. At the same time, consumer credit in February increased at a slow annual pace a little above 2%, and revolving credit barely grew at all. That does not look like a euphoric consumer binge. It looks more like households are trying to hold the line. And when households are trying to hold the line while inflation hangs around, businesses feel it. That's when discounting becomes a tool again. When promotions start showing up more aggressively, it usually means demand is no longer coming as easily as it used to. Businesses don't push harder for no reason. Promotions tend to multiply when demand stops coming as easily as it used to. A market can look quiet on the outside while conviction is quietly changing underneath. It can look like a mess of contradictory signals right up until one theme starts dominating the others. I'm not one of those people who says the dollar is finished every other week. That's lazy analysis. The dollar can remain more resilient than people expect, especially when the rest of the world has its own messes. The Federal Reserve's own exchange rate releases still track a broad trade-weighted dollar against major partners, and official discussions late last year described that measure as little changed, with outside forecasters expecting only modest depreciation. That is far from collapse. But here's where metals investors sometimes miss the forest for the trees. The dollar does not have to crash for silver and gold to do very well. It just has to lose some credibility at the margin. It just has to feel less trustworthy as a store of purchasing power. It just has to sit in a world where the policy response to stress is likely to involve easier conditions, more support, more liquidity, or some modern version of money creation with a respectable title attached to it. And that takes us directly to private credit. Now, for a lot of people, private credit sounds like one of those technical finance phrases that belongs in a boring conference room, not in a silver discussion. But stay with me, because this is one of the most important parts of the entire story. Over the last several years, as traditional banks pulled back from some lending and regulation tightened, a huge amount of financing activity migrated into private markets. Funds stepped in, direct lenders stepped in, wealth products stepped in. The pitch sounded great: solid income, attractive yields, sophisticated underwriting, controlled risk. And to be fair, part of that growth made sense. There was real demand for financing, and private capital helped fill it. But the problem with every fast-growing yield story is that eventually investors stop asking enough hard questions. They get comfortable. They assume the professionals know best. They start trusting packaging more than underlying risk. And when that happens, the market can look safer than it really is right up until the moment redemption pressure exposes the difference. That pressure is no longer hypothetical. Reuters reported just days ago that the Federal Reserve is asking major U.S. banks for details on their exposure to private credit firms after surging fund redemptions and rising troubled loans. The article also said banks have already tightened some lending standards, private funds have capped withdrawals, and the Fed is trying to assess whether stress in the sector could spill into the wider financial system. Treasury announced on April 1st that it would convene meetings with domestic and international insurance regulators focused on recent developments, emerging risks, and outlooks in private credit markets. When the official sector starts gathering this kind of information in public, it means the issue has graduated beyond niche chatter. And then you get the redemption headlines. Reuters also reported that Moody's shifted its outlook on Blue Owl's large credit vehicle to negative after redemption requests surged, with the fund limiting withdrawals at several vehicles, and requests in one case jumping to nearly 22% of shares for the quarter. Moody's said pressure could stay elevated and that inflows might slow, which could weaken liquidity and capital positions. It does show you that investor confidence in private credit is no longer bulletproof, and once confidence cracks in a market built on yield and trust, repricing can spread faster than people expect. Now, is this exactly the same as the mortgage disaster from the old financial crisis? No. And I think it's important not to overplay that analogy. The structures are different, the plumbing is different, the leverage channels are different, The rules are different, so I'm not going to pretend we are living through a frame-by-frame remake. That would be lazy. But I am going to say there is a family resemblance that matters. Once investors start believing that packaging, distribution, and professional management have somehow made risk more comforting than it really is, that's when trouble tends to hide in plain sight. And if growth slows while redemption pressure rises, the whole situation gets touchier. Because many of the borrowers funded through private structures are exactly the sort of businesses that looked perfectly fine when money was cheaper, valuations were higher, and refinancing felt easy. Stretch that environment, add weaker demand, add higher financing costs, add more investor nerves, and all of a sudden, the same assets do not feel quite as clean. The story changes from growth to endurance. That's when policymakers become crucial. Because history keeps teaching the same lesson in different clothes. When the financial system gets unstable enough, the response eventually bends toward support. Maybe it's a facility, maybe it's balance sheet action, maybe it's regulatory flexibility. Maybe it's rate relief. Maybe it's a combination of all of them. Markets know what that means, even when the language gets dressed up in professional terms. And precious metals usually start listening very carefully when that shift becomes likely. That is why I think the bigger silver thesis right now is not just about a chart. It's about a chart sitting on top of a macro backdrop that is getting harder to ignore. Sticky inflation, energy risk, a more defensive consumer, softer big-ticket demand, a labor market that is okay, but not comfortably so. A credit sector drawing fresh regulatory attention. That is a serious collection of ingredients. And one practical thing matters here. If silver dips on a recession scare while gold stays relatively firm, that does not automatically break the thesis. Sometimes that kind of split is exactly how the handoff begins. Gold catches the first wave of fear. Silver lags, gets doubted, then starts catching up once the market shifts from pure caution to monetary response. That sequence can feel more frustrating in real time, but it has happened many times before. There's another fresh angle on silver that almost nobody talks about carefully enough, and it's one reason I think the setup is stronger and more complicated at the same time. Recent industry forecasts say global silver demand this year could stay roughly steady, not because every major demand bucket is booming, but because rising investment demand may offset weakness in some industrial and jewelry segments. Reuters reported the market is still expected to run a structural deficit for a sixth straight year, with physical investment demand projected to jump strongly, even as industrial fabrication edges lower. That is important. Why is that nuance important? Because it tells you silver's support may be shifting more toward investment psychology and macro stress, and a little less toward the dream that every industrial use category must be firing perfectly at the same time. In other words, silver does not need a flawless growth backdrop to stay interesting. If anything, the latest outlook suggests investors themselves may be becoming a larger part of the story again. At the exact same time, there's a built-in counterpoint that serious silver people should not ignore. Reuters also reported that solar manufacturers are accelerating efforts to use less silver or substitute toward cheaper materials like copper after the price explosion we saw over the last year. In that report, the photovoltaic sector was said to account for a meaningful share of global silver demand, and higher silver costs were squeezing panel margins enough to speed up the push toward alternatives. That does not kill the silver story, but it does mean the industrial side is not one way. I like bringing that up because it makes the broader thesis more honest. If all I wanted to do was cheerlead, I'd skip the part where high prices can create resistance on the industrial side. But real analysis means holding both truths at once. Silver can be fundamentally compelling and still face industrial demand headwinds in specific areas. That is why the monetary and investment side matters so much in this phase. It helps explain why silver can keep attracting attention, even while some manufacturers start looking for ways to use less of it. And that loops right back into the old comparison everybody keeps making. Because what made silver so explosive in the famous move people remember was not only industrial demand, it was psychology. It was the shift from indifference to urgency. It was the realization that something monetary was happening under the surface, that confidence in the old setup was eroding, and that investors were suddenly willing to chase a much smaller market. When silver gets that combination again, technicals matter, but emotion matters even more. That's why I keep saying the setup is less about a perfect historical copy and more about a familiar kind of pressure building. A market can look quiet on the outside while conviction is quietly changing underneath. It can look like a mess of contradictory signals right up until one theme starts dominating the others. Now let me say something about the so-called petrodollar angle, because people either oversimplify it or treat it like a magic word. The truth is subtler. The dollar still dominates global trade and reserves in a way no other currency currently matches. That has not vanished. But what has changed over time is the willingness of more countries to test alternatives, settle some transactions outside the old habit, and reduce pure dependence at the margins. You do not need an overnight replacement for that to matter. You just need enough gradual diversification that the old automatic demand for dollars feels a little less permanent than it once did. And why does that matter for metals? Because gold and silver tend to do well in periods when monetary confidence shifts from unquestioned to conditional. The moment people stop assuming that the old system is untouchable, real assets get a fresh look. It doesn't require the end of the dollar. It only requires the beginning of doubt about how much privilege the system can keep indefinitely. While debt stays huge, growth gets bumpier, and policymakers remain boxed in. That boxed-in feeling is one of the most underappreciated parts of this story. If inflation were truly dead, policymakers would have more room. If growth were truly roaring, they would have more room. If credit markets were perfectly calm, they would have more room. But that is not the world we appear to be heading into. We appear to be heading into a world where inflation is lower than the peak, but still uncomfortable. Growth is positive, but less convincing, and parts of the financial system are drawing more scrutiny. That's not a comfortable world for policy. It's a compromise world, and those tend to be good for precious metals. I also don't want people rooting for some cinematic collapse because the best silver gains often come before the public fully realizes why they're happening. Once the panic is obvious, the trade is already crowded, the rules can change, taxes can become part of the conversation, and spreads in the real physical market can behave in frustrating ways. A gradual but undeniable repricing inside a stressed system is usually healthier for holders than some apocalypse fantasy. So yes, I'm bullish. But I'm bullish with a seatbelt on. I think that is the right posture here. Bullish enough to take the setup seriously, skeptical enough to respect the risks, calm enough to understand that silver can have one more ugly air pocket and still be in a larger, favorable structure, honest enough to admit that not every industrial trend is automatically bullish, aware enough to recognize that the biggest driver may not be a factory order at all, but a broader shift in investor appetite for monetary protection. That is where the fresh data actually helps. The latest inflation numbers tell you the pressure is not gone. The latest consumer behavior tells you households are still making trade-offs. The latest private credit headlines tell you financial stability, people are paying attention. The latest industry outlook tells you silver investment demand can strengthen even if some fabrication demand cools. Taken together, that is not a random pile of headlines. It is a mosaic. And the picture coming through that mosaic looks a lot more supportive for precious metals than many people are comfortable admitting. So when I look at silver here, I do not see certainty. I see asymmetry. I see a market that can still hurt people in the short run, but may reward prepared holders in the bigger run if the economy keeps wobbling and policy keeps drifting toward support. I see a metal that does not need every data point to be perfect, only enough of them to keep undermining confidence in the smooth, paper-first version of the future. And when that confidence starts slipping, silver has a way of going from ignored to unavoidable in a hurry. Gold tends to get institutional respect first. It's the cleaner monetary hedge. It's the thing large pools of capital understand immediately when financial anxiety starts rising. Silver is trickier because of its industrial side. That industrial side can make silver hesitate when growth concerns flare. But once the market starts believing that monetary debasement, easing, or renewed policy support are coming back into the story, silver can turn into the faster, louder trade. And the volatility warning matters so much. If you are positioned in silver, you need to emotionally prepare for a metal that can be right in the big picture and still very wrong in the short picture. It can scare you before it rewards you. It can drop when logic says it should rise. It can make you question yourself right before the environment shifts in its favor. If you're successful, share your success story in the comments so others can stay motivated. Because the people who usually handle these phases best are not the ones with the loudest forecast. They're the ones who understand sequence. They know the economy can soften without fully breaking. They know inflation can cool and then reheat. They know a credit problem can be contained until it isn't. They know silver can be sold for liquidity before being bought for protection. They know the move most people want is often delayed just long enough to test them. There's also something else worth saying plainly. Not every sign of value-seeking behavior means disaster. Not every cautious consumer signal means the recession alarm should be pulled immediately. Walmart's strength, for example, also reflects execution, grocery traffic, and digital convenience. Home Depot still saw some strength in professional categories in certain big-ticket areas. Payrolls are still growing. The official inflation trend, while frustrating, is not back at its worst. So I am not trying to force every data point into a doom-only narrative. That would be dishonest. But even after giving the optimistic side its due, the balance still looks uncomfortable to me. Because what we are seeing is not one isolated warning. It is a cluster. And clusters matter. Clusters are how the story changes. A softer consumer by itself is manageable. Sticky inflation by itself is manageable. Energy stress by itself is manageable. A fast-growing shadow credit market facing redemptions by itself might be manageable. But when all of those things start appearing in the same frame at the same time, the probability of a larger policy response later starts moving up. That is the thing metals care about. They care about what happens when policymakers get pulled into a position where maintaining stability matters more than preserving every last bit of monetary purity. They care about what happens when the market concludes that the next downturn will not be allowed to clear on its own. They care about what happens when the answer to stress begins leaning back toward liquidity. Because the next important phase in precious metals may not announce itself politely. It may come through confusion. It may come through one more ugly washout in silver. It may come through a jump in gold first while silver looks lazy. It may come through a credit headline that most people ignore on day 1 and care desperately about on day 21. Markets do not always ring a bell when the narrative shifts. Often they whisper first. So what am I watching? I'm watching whether inflation stays sticky after this energy surge or starts rolling over again. I'm watching whether consumers keep retreating from discretionary spending and leaning harder into value. I'm watching whether private credit redemption pressure broadens beyond the handful of vehicles already in the headlines. I'm watching whether officials keep treating the issue as contained or whether the language gets more urgent. I'm watching whether silver gets hit on bad news and then starts refusing to stay down. That last part matters a lot. Because when silver stops falling on the kind of news that used to knock it down, that can tell you something under the surface is changing. It can tell you stronger hands are taking the other side. It can tell you the market is beginning to price the next chapter before the public names it. And if that happens while gold remains firm, the move can get very interesting very fast. So yes, I think stackers should take this setup seriously. Not because I think every worst-case scenario has to happen. Not because I think the dollar vanishes. Not because I think private credit guarantees an immediate crisis. But because the risk map is getting more crowded, more connected, and more policy-sensitive. And that is usually a friendlier world for precious metals than for paper promises. Silver may not give you the easy path. It may give you the profitable path. Do not root for chaos. Do not fantasize about the system breaking just because you own some metal. A broken system is messy, restrictive, political, and unpredictable. That is not some dream outcome. What you want, ideally, is a fair repricing. You want metals to reflect the real pressure building underneath the surface, while markets still function and price discovery still works. But even without full disorder, the ingredients for a major precious metals move are sitting right in front of us. Inflation is sticky enough to limit policy comfort. Consumer behavior is cautious enough to question the rosy narrative. Private credit is strained enough to attract regulators. Energy is volatile enough to keep rekindling the inflation story. And silver, after a strong run and a nasty reset, is sitting in the kind of zone where it does not need perfect conditions to surprise people. It just needs enough pressure. So let me ask you this. Do you think silver gets one more big fake out lower before the next major leg up? Or do you think the move higher is already being built underneath the noise right now? I really want to hear your view on that. If this sharpened your thinking, stay close and subscribe, because this story is not getting simpler from here. And just one last thing, this video is for education and discussion. I'm telling you how I see the setup, not giving you a personal financial blueprint. Check the data, think for yourself, manage your risk, and make decisions that fit your own situation instead of borrowing conviction from anybody else.